welcome to another Market Matters video update. Today we're going to talk about two very different sectors in the ASX space today. Firstly, we're going to talk about banks, then we're going to go on to the mining services. We spoke about the banks a little bit in this morning's report. What's going on there? Just want to recap our views on the space as a whole, I guess, James.
Yeah, you're not wrong about two different sectors. Banks have obviously been performing really strongly. Mining services have been really weak, and they're for obviously different reasons. So just if you think about the banks, and I wrote about it this morning around the, sort of dumbing down our thoughts on the banks overall. So you think about the economic backdrop and what banks actually do. They're very much leverage proxies to economic growth or contraction or economic conditions more broadly. So we've seen an acceleration in many economic metrics that we keep a really close tab on, obviously supported by government stimulus coming out of COVID, but now we've got a situation where the RBA is saying they're going to keep their foot on the pump in terms of support. Interest rates are going to stay low out to 2024 if you believe them. I don't think they will stay as low as they are now out to 2024, but basically the backdrop for banks is a strong economic tailwind for the sector at the moment, and CBA we saw trading at all-time highs yesterday, Harry.
Certainly. So they tend to move in lockstep with one another, but every now and then you see relative valuations open up. We own CBA and NAB in the portfolios at the moment. How do we see the relative value between the big four right here, right now?
So CBA is generally trades at a premium to the others. It's a better bank. There's a heap of reasons for that, but it's simply a better company than the others. The traditional metric around price to earnings ratio, it generally trades at a 16% premium to the sector. Right now it's trading at a 32% premium to the sector, which is obviously very high. If you look at the other metric that you tend to use around the banks is price to book. So book value is the carrying value of assets on their balance sheet. CBA trades at 2.3 times price to book. The other banks or the sector is trading on 1.3, 1.4 times price to book. But if you look at the extremes, so the extreme on the downside in terms of that would be Virgin UK. That trades on 0.6 times price to book. The regional banks are 0.9 times price to book, so a discount to their book value, and then the Westpac, ANZ, NAB, etc., trading sort of 1.3, 1.4 times price to book. So I guess the key takeaway here, Harry, is that CBA is expensive relative to the sector. I think we stand back here. There's reasons why it's expensive, and I think the market's got optimistic around the prospect of capital management. So they've got the best capital position, and then the market's looking forward and saying, well, they can return some of that to shareholders. So right now, I'm just becoming, CBA is our biggest position. I'm becoming conscious that it is overextended in a relative sense versus the other banks.
Maybe a switch coming there. Moving on to the other barbell of today's video, the mining services space. Mining in general, printing cash, gold's up, iron ore's up. Most commodities are doing really, really well this year. The other side of that trade usually is the mining services, but they've really struggled at the moment. We hold MNW and NRW. NWH is the code for that one. Why are we seeing some underperformance by those names here? Yeah,
they've been poor. There's been, these positions have gone from, really strong profits, and we've seen a lot of that evaporate over, in recent times. So they've been a major disappointment. If you think bigger picture, mining doing really well, commodity prices high. Mining is a cyclical game, so high commodity prices incentivise new mine production, and that should be helping the mining services stocks. And it is from a revenue perspective. So as well as the infrastructure spend that a lot of these mining services companies also weigh in and produce work for. So you think about that backdrop, it should be supportive. So the revenue line of the mining services business is strong, so they're growing the top line, but they've had issues around wages and finding workers. So A, they're finding it difficult to find workers, and B, they're having to pay them more. So that has a negative impact on margin. So you're seeing, like in the case of NRW, revenue is up 10, 15%, but earnings are down 5%. So you've got this short-term issue, I think. So if you think about how that plays out over time, and this speaks to why we're still holding NWH and MND. So you think about, these mines, they need to get built. They need to have, produce the things that they're producing. So they need to get workers on site. They need to pay these contractors. As commodity prices remain high, they can now afford to pay contractors more, and contractors can in turn start to pay staff and attract staff by paying them more. So I think it's a short-term thing. So I think the margins contracting is a shorter-term thing. I think if I look out 12 months, the sector looks a lot better. So that's why we're sort of holding firm for the moment. And you think of NRW, it's trading sub 10 times earnings. If you look 2 years out, the earnings of that business look really, really strong. So we're holding those for now, Harry.
Certainly. I think you just stole my last question off me there, James. So we'll leave it there. Thanks for joining us.